All right, friends, it's that time. Oh, yeah. We're going to get down on a Friday. We're going to have some fun. Today, I'm going to go through, I just think it's an important education in how all this stuff works in my world, in the world of home loans. Is there one place, one bank, one way of doing things that always has the lowest rate? There isn't. There isn't, because there's always moving margins in different places and different markets. So there's never one place you can say, oh, that's the place to go to get the absolute lowest possible rate. But there are places where you can go that tend to have the lowest rate more often and tend to have better service than some of the other places that are competitive with those rates. So I was just going to show you how this works today. And then I'll go through my normal timely stuff. We'll look at what's going on in the market, what happened today, and so forth. So this is not to scale. This is rudimentary. This is conceptual only. So don't hold me to the fire for this being exactly accurate. But what I want to just explain is in a conceptual standpoint, why is it the case that Bank A has a certain rate, Bank B has a different rate, and Bank C has a different rate? How is it that everybody has different rates? And there's a lot of things that go into that. So I'm going to kind of show you today what I mean by all this. All right. So first of all, just kind of the X factor here. Retail banks and credit unions, they're just kind of a question mark. Maybe I shouldn't put an X. Maybe I should put a question mark. They can kind of do whatever they want, especially like a credit union that's lending their own money, their own deposit funds out, and they're not necessarily like flipping. Like you'll see sometimes a credit union might have a crazy rate or a crazy deal for a certain product or for a certain type of borrower with the right amount of down payment. If you fit into the box, you might get like a crazy deal. You'll see those things happen. I haven't seen or heard of a credit union that provides like the kind of quick and detailed and 7-day-a-week service that most mortgage banks or mortgage brokers would. Retail banks are pretty brutal for mortgages, but again, it's a question mark. Sometimes I beat. In fact, I would say probably half the time I'm beating the retail banks. The half of the time that I'm not, usually they're just doing a deal for nothing because someone's got a couple $1 million with them. So we're just going to say these two are a question mark for right now because they're just so all over the place and it's so dependent per. But mortgage banking and mortgage brokering, you can kind of break down. So I just want to explain this. So I'm using over here on the left, these are just random numbers, 4.5%, 5%, 5.5%. Just want you to understand that like everybody sort of starts at the same place. Like there's this zero par place where the money comes from. That's like the bond. Everyone kind of starts there. So what happens? How do we get in misalignment through the process? So if you work for a mortgage bank, you have what's called off the bat. Oh, wow. We're going to start with really ugly rectangles. You have the margin of the bank, and that could be 50 basis points. It could be, 75 basis points. It could even be 100 basis points. They'll never tell you. You'll never know unless you're on the inside of one of those things, but there's definitely margin there that goes to the actual bank itself. And then on top of that, you can see how that kind of increases. Man, is this thing going to be weird? This kind of increases the rate, right? Each time we're adding margin or we're adding to this, the rate is going up, right? We're adding margin in. This here is what we would call like the branch margin. So let's just put a B here. So when you work for a bank, you have the bank and then you have a branch, right? And this branch also has a margin, which this could be a lot more. This could be 200 or even 300 basis points, or it could be more. So let's just say for this sake, it's 200, which would be really low. The last bank I worked at, that was the lowest margin of any of the products they had, and it went all the way up to 375. So you have this being added in by the branch. The branch has to pay for their lease. They have to pay for all the people who are working in the branch. So they need a certain amount of margin on there. And then you have the loan officer compensation. Usually in the banking space, this is like 100. And that just goes to the loan officer. They get their commission for doing the loan. They don't have any expenses. The branch handles all the expenses. The loan officer, gets the comp. So this is the LO here. All right. And so by doing this, and again, not an exact example, this is not to scale or anything, but it just shows you like, okay, so we've added 350 total So the total here, we've added 350 basis points to the base rate. And now that's taken us from, 4.5 up here closer to, 5.5. And that's what that, in this very rudimentary, rough example, that's what the mortgage bank would be offering, 5.5%. Now, as a broker, we kind of keep things simple. We don't have a bank margin. We don't have a branch margin. And most of the LOs that I know in brokering are doing like 150, which is what we do. You do 150 on the comp, and that's just total, and that's it. So you get your 150, and your broker and everybody gets their cut out of that. So essentially, that's where the margin stops. So you can see here why that would be the case, that a lot of times mortgage brokers are going to have lower rates than mortgage bankers. Not always. And when the retail banks and the credit unions typically are doing the best in the competition here is when rates are going up. They tend to get their money way ahead of time. They reserve their funds ahead of time. So if rates are going up, they may still have money reserved at much lower rates. If rates are going down, their rates might be really high because they've reserved that money at much higher rates, and it may take them a while to get through that money. So they may have elevated rates for quite some time. But most retail banks and most credit unions don't focus on mortgage. It's just something that they offer because it's right there and they have people who ask for it. So their cost per acquisition can be really low. And so that makes it, sexy for them to add to their portfolio. But this is essentially how it works, and why typically mortgage broker, and this is why I became a mortgage broker, because I want to be able to offer people the best deal, whether it's with this bank or that bank or whoever has the best deal today. I want you to be able to get that. I don't want to have to just sell one bank's rate sheet. So this is a rudimentary example, but it gives you an understanding of why the broker world has flourished so much, why so many people are becoming mortgage brokers, and why you will typically get a better deal with a mortgage broker. A good example of late was, in fact, just yesterday, when I had someone who was working with new construction lenders. So they're getting all sorts of incentives. And even with all the incentives they were getting, I was still able to save them $2,000 and a quarter of a point on the interest rate. So, and that was through a very big mortgage bank that they had their pre-approval through. So there's definitely something to be here. Now, in some cases, like with new construction, maybe that LO comp is cut in half, or maybe the branch margin is reduced significantly. So they're tighter. Maybe they're down here. Or something like that. So you can play with that. It all depends on how efficient your branch is, and how efficient your overall business is on that side, because there's so many expenses. As a broker, we're basically lean and mean. We are typically working from home or have very inexpensive office setups, just trying to keep those margins down, trying to keep expenses down, fixed expenses down. Pretty much everyone works on commission. Even administrative people will work on commission in the broker world, which makes it easier to keep total expenses down, because you don't have like salaries you have to pay on. If you have a bad month, then everybody has a bad month. If you have a bad quarter, everybody has a bad quarter. You don't have that fixed cost to really eat into, and particularly the retail costs for office space and things like that. So this is just a rudimentary example of how this works. Now, from a service standpoint, that's going to be from loan officer to loan officer. Typically, retail banks and credit unions are going to be 8 to 5, Monday through Friday. Mortgage banker LOs, a lot of them will work 7 days a week. A lot of them will work in the evenings. You just kind of have to go LO by LO. And same thing with mortgage brokers. But the focus on mortgage, usually bankers and brokers both know that it's a 7-day-a-week business, and they're going to be available for you 7 days a week. For example, today's a Friday, and I'm perfectly ready and willing and able to work this weekend as needed. And you just kind of have to be able to do that. Okay, so hopefully that answers that. And if you have questions about any of this stuff, this is an evergreen video. Give me a shout. If you want to get a free quote, find out how much money you could save. Maybe you're already in escrow. Maybe you are about to be. Maybe you've just gotten pre-approved. I talked to a gentleman today who just got pre-approved, and I asked him, well, what rate did they pre-approve at? He said, I don't know. They didn't tell me. I said, well, what were the lending fees? He said, I don't know. They didn't tell me. They just told me I was pre-approved for $650,000. That's crazy, folks. And it's also a bad sign. It's really a red flag if you get pre-approved and they don't give you details. So I sent him on his way to go ask for those details. Go get those details, bring them to me, and let's compare notes. Then we can do that for you too. I'm happy to do that for anybody. Call, text, email, get a free quote, figure out what is going to be a good deal for you. Okay. Time to dive in. Oh, what have we got going on here today? Team. I don't know who it was, but somebody recently has been pretty bullish and has been expecting this big run. I still haven't covered my NASDAQ short. I'm in such good position on it. I don't have to, cover on a day like today. Big rally on a Friday. What does that mean? We're going to look at mortgage rates today too. Bonds had a really nice late rally. Everything rallied late today, looking really, really good here. And people think I'm crazy when I'm like, hey, rates are going to go down. I did do the television segment today on One American News. And the main thing I wanted to say, I got to say it, which was great. Hey, when the Federal Reserve raises rates, mortgage rates are going to go down. I know it's hard to understand. I know it's counterintuitive. I know it doesn't make sense on the surface, but that's what's going to happen. It happened last time. It'll probably happen again this time. We got 0.25% drop in rates last time. Maybe it'll be a little more priced in this time. Maybe we'll see a rally ahead of the meeting at the end of the month, just a couple weeks away. Hard to say. Maybe this is the beginning of it. But as I was saying yesterday, we got these really nice wicks on these candles here. These are daily candles. And that's usually a sign, especially when you get them consecutive. We call that tweezers. You get tweezers, you really want to take a trade in the other direction. You really do. You really want to take the trade that, hey, this is going to move this way. And that's why in the video yesterday with Dan, I had 2 arrows pointing up and only 1 pointing down, because I really felt like, hey, based on the way this looks much more likely to bounce higher. And remember, we want to see mortgage bonds go up because that'll mean that mortgage rates go down. Mortgage rates are not in any way affected by the federal funds rate. They can be, however, affected by the Fed when the Fed is buying or selling, which they haven't done yet, mortgage bonds or mortgage-backed securities. So this is playing out nicely. Nice run at the end of the week. I'll take it. We're still not back where we were, 7-8 days ago, but we're on our way back up there. So the ground that we've lost, we're chopping away at it, and that's a good sign. That's a good sign. So we're seeing those FHA and VA rates in the mid 4s, seeing conventional rates in the low to mid 5s, jumbo arms in the low 4s if you have enough down payment. So stuff looks good. Rates look good. I definitely want to make sure we mention that. Okay, so pretty much everything was up today. Crypto up across the board. Oil was up. The only thing I think that was pretty much flat was gold. Poor gold, down to 1,700. Poor gold. Dow rallies 650 points. Look at that. It just jumped right over resistance. It was crazy. Actually, I think I have this chart up. You can see this resistance here. It just jumped right over it. From yesterday, right here, this was serious resistance with the close yesterday, and it just absolutely leapfrogged it. It went higher today and then trended sideways pretty much the whole day. That's a 1-hour chart. But ultimately, there's a few things I think we should discuss today, and then we can call it a week. There is still a tremendous amount. I know you've heard me say this before, but there's still a tremendous amount of my $31 billion in trade rail landlocked, so just stuck on trains or just stuck at anchor off U.S. coasts. So we have a ton of stuff. Why is that important? Because when stuff is stuck, that's inflationary. Because you're lacking supply. When supply lands, when this glut gets unclogged, that supply lands, that should really help, right? Because now we don't have such a shortage of supply. We have stuff that should help prices chill out. Also today's city, and I think this is the real reason for the rally, even though it could be my original estimation that, hey, inflation, the worst of it's probably behind us now. I think that's pretty likely. I'd say more than 50-50, the worst of inflation is behind us. That's why I was expecting the rallies. This was definitely fuel for that. The Citigroup had a great quarter. Profit estimates were really good. Check out what the CEO said. I mean, if you're invested in a company, particularly a bank, this is what you want to hear. In a challenging macro and geopolitical environment, our team delivered solid results. We're in a strong position to weather uncertain times, given our liquidity, credit quality, and reserve levels. We sitting pretty, y'all. I mean, that is what you want to hear from a CEO. And Citigroup's obviously huge. But look at this. Earnings per share. I mean, they did such a huge beat. $2.19 versus $1.68 expected. Oh, my goodness. Overall revenue was there, too. Upside surprise. And then the company, of course, had a big day today stock wise. So, there was not everything was great in there. Profit declined, a little bit. There was not everything was perfect, but it was greater than expected, right? And it was showing that like, hey, these banks are in really good shape. Like last time, we had a macro in the crash. We had a macro issue with lending, with finance. The whole system was a fraud, basically. And everyone was leveraged to the gills. Nobody had cash. Nobody had reserves. We're talking yesterday about how JP Morgan setting up reserves, making sure they're setting aside cash, they're not paying dividends, doing this and that, trying to do things that are like prudent. And we're seeing some more prudence here. Those are things that are good, that point away from a crash, point away from the doomsday stuff that's going around. Also, Prime Day. I don't know who participated in this. I order so much stuff on Amazon, and the one day I don't think I ordered anything was Prime Day. Pretty stupid. But they had a record Prime Day. A record. Can you believe that? For Amazon. We don't have record like spending days coming up to a crash. Do you know what I mean? Like if we're still worried about a crash, these numbers would be coming in looking bad. Hey, Prime Day came in 10% under expectations. That might be a red flag. But to set a record, I think it just shows you that people aren't in as bad a shape as some of the news might want us to think, or some of the YouTubers, doomsday YouTubers out there want us to think. People are still pretty well positioned money-wise and still spending. Because if they were well positioned money-wise and not spending, that could be a different kind of problem. I do want to talk about this too, because we've sort of gotten away from this as the crypto world has been crushed. A lot of the talk behind metaverse has subsided. Meta, the stock, is a smoke and buy right here, in my opinion. I have been buying it every single week. I have been in there pulling the trigger. And I'm excited about the position I'm building in it. I think it's going to be amazing. Tony Hawk, he's entering the world of NFTs with the biggest skate park in the metaverse. Of course, anyone who has a big name, anyone who has something to shill is going to have a storefront in the metaverse. There's no doubt about it. That is coming. The future is much more digital than now. And it's been that way for ever since digital became a thing. The future is more digital than now. And I think the metaverse is going to be a big part of that. So I'm still making a big bet in that direction. This was something that I haven't been saying the right way. And so I'm glad that this article came out to help me realize like there's a better way to say this. But remote working, an unlikely ally in the Federal Reserve's inflation fight. Well, if you work remotely, or you have the option to, that can help you save money by not having to buy gas, or by being able to be flexible with things, being able to save money in different ways, right? Here's a couple things here. So employees benefit from remote work via less commute time, better work-life balance. Many employers also get a financial perk by somewhat limiting workers' pay growth, according to a new research paper. Over a 2-year period, employers offer wage growth that's 2 percentage points less than otherwise would have been. And by capping wages, researchers argue remote work has helped mitigate already high inflation. I don't think it's the wages necessarily, but it's just the overall efficiency. You're able to have just a more efficient setup, which is good, and you can cut costs more easily as well. So I don't think this, small amount of wage growth has anything to do with it personally, but other items within here do. And so I thought this would be a good one to check out if you want to look at what in the heck has he been talking about? How's that such how is that even a thing? And ultimately, what we're looking at here for next week, what I'm expecting, what I'm hoping to see, we've got a challenge here with a couple important resistance levels that are right at the same price pretty much here on this mortgage-backed securities chart. And if we can bust through that, look at the green pastures. If we can get through that, look at this. We have no resistance for like 120 basis points. So I would like to see that. If we can get this next, 50, 60 points, there's another 100 right there. And people don't realize that the chance, the possibility for a huge drop in rates, a quick drop in rates is on the table. A lot of people don't realize this. The possibility, we say this one more time, for a huge drop in mortgage rates very quickly is on the table. If inflation is subsiding within a month, we start to see inflation numbers come in lower than previous months, lower on a year-over-year basis, anything like that, you could start to see these bonds get bought up in a big way. And it could happen over the course of a week or 2 weeks where rates drop a point. That's where I'm guessing right now is the sort of best case scenario. And what does that do to the market if that happens? That's a question you've got to be asking yourself right now, especially if you're a DPA buyer, FHA buyer, VA buyer. You've got to be asking yourself that question. You know, wouldn't that be great if I was in a position to purchase, ready to go? Because when rates drop initially like that, you won't see sellers, it won't impact sellers right away. They won't know, necessarily that to wait a little bit and let the buyers come in. So they're at that point in time will be the best time to buy. You'll be able to have your cake and eat it too, and it'll be a short window. So that's the thing to look forward to if you're a buyer or if you're an investor like myself. If you're an investor, you are probably right now going ahead and liquidating some stuff and getting yourself into cash and getting your binoculars out. And I know that's what I'm doing. And so what that really means is you're getting ready to launch as soon as an opportunity presents itself. And I'm 100% doing that myself. And I think that is the prudent thing to do here. I mean, if the market's weakening, if there are desperate sellers out there, then as investors, those are opportunities. As home buyers, those are opportunities. But I can tell you right now, it's not just me. There are a number of people. There's actually quite a few people who are going to be, that I know of, who are getting their cash together and getting ready to start, hitting the market, hitting the streets, let's say, start looking at properties, start making offers, just from a pure investment standpoint, not from a flip standpoint, but from a long-term investment standpoint. And, we'll see if that puts a dent in the market. We'll see what happens out there. But I can also report this. Definitely this week, I'll probably go back to next week as well, or last week as well. Definitely seeing an uptick in interest. Definitely seeing an uptick. We're not back to where we were when it was crazy, of course, but I was reporting that I was probably 25% of the normal activity from buyers that I would see, like new buyers saying, hey, I'm interested. Hey, I want to get pre-approved. And now I'd say we're more like 40-50%. So that has really ticked up in the last week or two. And I think that's a really strong sign that there are a lot of people who still want to buy in this market. And we'll see if they actually do buy, though. People contacting, being interested in buying is different than people buying. So we got to see what happens. But there's definitely some good news that I wanted to report. And of course, I'll be around this weekend. If you guys need me, give me a shout, call, text, email, whatever you need. Quick pre-approval, rate quote, make sure you're getting a good deal. I'll be here for you. I'll try to save you some money. I'll try to bring you the goods whenever possible. And of course,
all we want to do is pump you up.
You guys have a great weekend, and I will see you soon.